So how do you get as much cash value as possible with a whole life insurance policy? I spoke with someone recently who was referred by a friend regarding whole life insurance, and he said, I'm interested in a policy, but I only want the cash value. I don't really care about the death benefit. This individual, super sharp guy, works at a public company, has an engineering background, he's in the highest tax bracket because he makes a lot of money, so he's interested in the life insurance product for the cash value because of the benefits that come with it. The safety, the fact that he can access the cash value anytime without penalties, and then the big one is that it's tax-free. However, he's looked into whole life insurance in the past and said, this isn't for me, because what he saw was just ugly. So what we're going to go through in this video is what we went through with him, which is a step-by-step guide of how to set up a whole life insurance policy for as much cash value as possible. So step number one, where we recommended he start is with the company selection. So when it comes to a whole life insurance policy, there are a lot of companies out there where I would recommend starting is with one of the four major mutual companies. So company choice, the four major mutuals are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Let's just call it four majors. And again, to list those out, you've got Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The main reason why is when we look at policies with these companies, specifically when someone is interested in whole life insurance for the cash value, the biggest source of buyer's remorse that always occurs is that the actual results, someone's cash value that is, under-delivers compared to what they saw in the illustration. Where we have seen that not happen is one, with these four major mutual companies, and then two, here's step two, when the policy is set up correctly. So we'll refer to this as the policy design. And here's what it means to set up a policy correctly. When you put any amount of money into a policy, say it's $1, you can choose where your money goes. Instead of just buying a life insurance policy, what we would do is say, how much money do you want to put in? Or we would determine that after meeting with him. He said $10,000 per year is what I want to put in. What we would do is break that $10,000 up because it could go toward the insurance premium, or it can go toward what is called your PUA, which stands for Paid Up Additions Rider. Now, premium dollars do not build cash value in the first year. Sometimes it's the first and second year, whereas PUA dollars build cash value immediately. So the name of the game is reducing the premium as low as the insurance company will allow us to reduce it, and then maximizing that PUA rider. If I can just stuff that PUA rider, that'll give me more cash value from start to finish. So step one, company selection. Make sure we always look at one of the four major mutual companies. And then step two, make sure the policy is designed with a minimum premium. Of the four major mutuals, we can typically set that minimum premium at about 10% of whatever our maximum payment is. So if you said, the most I ever want to put into this policy is $10,000 on a yearly basis, then I know with most companies, we can set that minimum premium at about $1,000. That means I'm committed to $1,000 and I can add more money to the policy, specifically toward the PUA rider, at my discretion. Now, as a quick side note, we would also need what is called a term insurance rider here, and that is to prevent what is called a modified endowment contract or a taxable event. Okay, so this leads in to step three, which is how do I squeeze a policy for all it's worth? So simply put, how do I get the absolute most value? And for this, what we want to know here is what I like to call the rules of the game. So what we looked at for him in terms of company selection were two companies, Mass Mutual and Guardian. A big reason why is because they're two of the four major mutuals. We know that the performance is there. We track policies. I've seen it year in and year out. And then two, you can design the policy to be very flexible. Now, all companies have different rules here. So what we went through with him specifically had to do with the premium and PUA limits. So what he wanted to do, ultimately how much he wanted to pay in, was about $75,000 per year. And that was for a policy for himself, and then also a policy for his wife. So it's a total of $150, but we're gonna focus just on him. So that's how much he wants to put into the policy, $75K per year for a period of 10 years. You'll see that he is 55 years old right now, so he wants to fund it until he's 65 years old. So with both companies, with that premium, how low can I set it? Well, wherever I set the base premium with MassMutual and Guardian, both companies will allow me, the agent, to illustrate in their software up to 10 times the base premium in PUAs on a yearly basis. With MassMutual, that's with all of their products. With Guardian, that's with most of their products except for their 10-pay product, which with the 10-pay product, specifically with Guardian, the most we can illustrate is 5x the base premium in PUAs every year instead of 10x. So what that means is with both policies, I might have a base premium of about $7,500. It'd actually be a little bit less than that with both of them, but we're just gonna round and set it at 10% here. So base premium, $7,500 with both companies. The exception here is with Guardian, their 10-pay policy, the base premium would actually be about $12,500. And the reason why is because the rules are different with that specific product as far as how much I can add to PUAs, in addition to the base premium, that is. And we are going to look at an example in a little bit. Now, squeezing a policy for all that it's worth. Both MassMutual and both Guardian, if I want to pay $75,000 per year, the lowest I could set that minimum premium is $7,500. With the exception of the 10-pay product with Guardian, the minimum is going to be about $12,500. An exception is this: with Guardian, in the first year, we can actually illustrate, and you can pay up to 50 times the base premium in a PUA payment. So they do allow a large first-year lump sum that can just be dumped into the policy, which will help maximize the cash value. So that is a very attractive feature when we look at it. So step 3, to get the most value, really just understand the rules of the game, specifically how low I can set that premium and how much additional money I can add to the PUA rider. Step 4 that we went through with him, flexibility. This one's huge, because when I think of an insurance product, regardless of what type of insurance it is, it's usually kind of boring to me, where a benefit is only paid if something bad happens, like if it's auto insurance, I get into an accident and then a benefit's paid, but I have to pay a fixed premium every single month or every single year. So with a life insurance policy, when someone is interested in the cash value, they typically do not want a boring bill, which makes sense. They want the ability to fluctuate what they pay into the policy. They're using it like a savings asset instead of just a boring bill. So knowing the rules of the game, this is important here as well. When I look at MassMutual, I can have that set up where my minimum premium is $7,500. And I've got the ability to throw another $67,500 into the policy for a total of $75,000. So let's write it out here quick, because I know this stuff can be deep. So when you add the base premium, $7,500, plus the PUA payment of $67,500, what do you get? $75,000 per year. That's how much he wants to pay in every year. Okay. So with MassMutual, when it comes to their flexibility, the PUA rider payment can be adjusted. The thing is, we can typically only adjust it one time per year. This can be every year, but on our policy anniversary date, which is a fancy word for the premium due date, when the premium is due. Now, an important side note with MassMutual products, we would need to design it correctly. So they've got a couple PUA riders referred to as their AILR, which stands for Additional Life Insurance Rider, which is just a pure PUA. And then also LISR, which stands for Life Insurance Supplement Rider, which is a combination of a 1-year term insurance rider and a PUA rider. That rider is really what builds in additional flexibility where I can scale my payments up and down as time passes without having to worry about going through underwriting. And I can miss PUA payments for 5 or 10 years or more than that, and as long as I still have LISR attached, I can scale that PUA payment up again in the future without medical underwriting, which is huge. So the big thing with MassMutual, to keep this high level because there's more detail here, but the big thing is I can make those payment adjustments 1 time per year on my anniversary date. Whereas Guardian, when I look at funding flexibility, I can set it up the same, assuming I'm not starting with a large lump sum. But here's the difference. So let's change the company name to Guardian. So if I've got the same setup, Guardian will allow me to commit just to the minimum premium. So I can be billed literally for $7,500 per year. I can even break that up over 12 months if I wanted to. And then when it comes to PUAs, I can literally add those at my leisure. I don't have to hit the extra 67.5 every year, meaning I don't have to hit a total of 75 every year. Same is true with MassMutual. I'm not required to put the extra PUAs in. But with Guardian, when I say at my leisure, literally what that means is I can log onto my mobile app, online account, can send in a wire transfer, can be a check, whatever it might be, and just dump extra money into the policy every week, every month. Ton of flexibility there. So people who see their cash flow fluctuate, or they're just more comfortable with the idea of being committed to a minimum premium and then have the option to add more money to their policy at their discretion, typically like Guardian a lot. Whereas MassMutual works really well for someone that already has excess cash on hand. And then also they work really well if someone says, I want to be able to fund a policy for 20 or 30 years, and I want a 10% minimum premium as well. So step 4 that we wanted to cover was funding flexibility. This way he understands what is available with different companies so he can put money into the policy in a manner that is not burdensome to him. So it's very, very convenient. So we're getting toward the end of the steps, and then we're going to look at some numbers here. I hope you are finding this helpful and interesting. Let's shrink this a bit, but not get rid of it. Next, our 5th point, dividends. Really just understanding them. So this is not a step where an action item is required on your part, or in this case, on his part. When he looked at those 2 companies, so we had MassMutual and Guardian, for 2025, MassMutual's dividend rate is 6.4%, and Guardian's dividend rate is 6.1%. So the question I always like to ask here is, Mr. Prospect, who's interested in a whole life insurance policy, if you have $100,000 in cash value and you see a dividend interest rate of 6.40%, what do you think your money will grow by that year? Pause. Wait for it. Usually I hear $6,400. And that's exactly what I would say, because 6.4% of $100,000 is $6,400. The thing is, whenever I look at a dividend rate, and the same is true of a guaranteed cash value interest rate, it is always a gross rate that is applied to my policy after the company's insurance expenses and everything that comes with a life insurance policy. So what I want to look at here is the net return. If I want to see the net return on a yearly basis, I can ask for the annual yield. That's fine to look at. You'll see this with banks, bank-owned life insurance illustrations. We'll use this specific term here, annual yield. What that shows is just my yearly rate of return. So let's call it annual ROR. That's if I want to see the net return on a yearly basis. If I want to see the average, what I would request is what's called the IRR, which stands for internal rate of return. This will show the average net growth rate as time passes. So step 5 is really just setting expectations correct when it comes to dividends and how they work. Because where people get frustrated is when they get a policy and they're told, look, your dividend's 6%, that's what your money's growing by. And then after they start it, they pull out their calculator, they start crunching the numbers and say, wait a minute, I'm not earning no 6%, what's going on here? And now they're not happy because expectations were not set. And then they say whole life insurance stinks, my agent's a scumbag, why did I ever work with him? And it gives the industry a bad reputation, which we don't want. It kind of is what it is. We just need to explain it properly up front. All right, the last item to hit on, and then we'll look at some numbers quickly, policy loans. So again, when we look at the two companies here, we had MassMutual and Guardian. He wanted to understand how loans work with them. So MassMutual offers 2 loan rate options. They've got a variable loan rate, and then they also have a fixed loan rate. Now, whichever one you pick, you're locked into forever. So their variable loan rate as of January 2025 is 5.33%. And it is tied to Moody's Corporate Bond Indexed Average, which is just a AAA rated bond. It moves up and down with interest rates as the years pass. Their fixed interest rate is 6%. Now, if you select the variable loan rate, the policy will be what is called a non-direct recognition policy, which means regardless if you take a loan or not, you will get the same dividend on everything, unborrowed cash value and borrowed cash value. Whereas the fixed loan rate is a direct recognition policy, which means you still get dividend on everything, but it's not the same dividend. You will get a different dividend rate on the money that you borrow against your policy, which when we look at illustrations now and the past several years, the dividend's a bit higher than the current dividend interest rate of 6.40%. A common misconception when it comes to direct recognition is that your dividend is always lowered when you borrow. Not the case. Always depends on the company and their specific rules. Guardian, how they work. Their contracts always start out with a fixed loan rate, and these are for new contracts. If you have an older one, it might be different than this. It's 5%. But if you pay the loan interest, if you have a loan outstanding, if you pay it on your anniversary date, which is when it is billed, it is actually discounted to 4.76%. And then what happens is at the 10th year, you have the option, not requirement, but option to change to a variable loan rate. If you do, it works similar to MassMutual's variable loan rate in the sense that it's tied to Moody's Corporate Bond Index, right? The floor is 4%, and right now it's over 5%. But that's the option. If you said, no, I'm not going to do that, I'll just lock in the low fixed interest rate. Then what happens is at the later of the 20th year or age 65, whichever comes last, what'll happen is that fixed loan rate drops from 5 to 3.5%, which is also discounted. I believe it's 3.3. I got to look it up. It's 3.3 and change if you pay the interest, but it's discounted to a fixed interest rate of 3.5%. There's an exception to that, which is the 10-pay policy, which what we don't like about that Guardian product is the forced higher premium. But what we do like about it is when we look at that fixed loan rate, what happens is it's at the later of the 10th year or age 65 that it doesn't drop to 3.5%, it drops to 3%, which a lot of people like if they plan on using the product for income down the road. We just met with an IP attorney yesterday who has a mechanical engineering background, super sharp guy, just mowed through all the material for the life insurance product. But that really interested him because he's interested in the product for income down the road. Make sense? So those are the 6 steps that I would follow. And just to recap, here's how I would go through them. Number 1, company selection. Make sure we are asking, at the very least, about the 4 major mutuals. 2, policy design. Make sure the product is set up for as much cash value as possible. Specifically, we do that by reducing the base premium and maximizing the PUA rider. If I look at the 4 major mutual companies, I can typically push that base premium as low as 10% of my total desired payment. Number 3, how do I get the most value or squeeze a policy for all it's worth? Know the rules of the game. So we've got that 10% minimum premium, call it a 10/90 split, but knowing the rules of the game, you've got some exceptions. 10 pay with Guardian. I can only pay 5x the base premium in PUAs every year. But I've got that first year where I can go up to 50x, and that's with the 10 pay and all other Guardian products as well. 4, flexibility. If I look at the 2, Mass Mutual allows me to make payment adjustments, specifically PUA adjustments, 1 time per year on my anniversary date, whereas Guardian, on the other hand, will let me commit to the minimum premium and then dump in extra funds to my PUA rider at my discretion. Dividends. Understand just how they work from a transparency perspective. So we've got Mass Mutual's dividend at 6.4, Guardian's dividend at 6.1. That's not what I'm actually earning. I want to see the net returns. I can ask for the annual yield, which is my yearly rate of return, or I can look at the averages by looking at the internal rate of return. And then loans, I just want to understand if it's a variable loan rate, fixed loan rate. I can ask if it's non-direct or direct recognition, although I don't think that really matters too much when we look at historical performance. And then also know about these other features that are available with different companies. So after seeing all of this, he said, I'd like to see some numbers. Let's look at what we showed him. So he narrowed things down to Guardian because he did like the flexibility. Originally, we looked at both. We'll always look at different companies, products, options, because we don't want anyone to ever feel like we're not showing them something important. So what we looked at is their L95 product, because he asked for a product with the lowest fees and the lowest premium. This product provides that. Here's the minimum premium, $6,800 and change. We also have a term insurance rider attached that prevents a MEC. When you add those 2 together, it's a little bit higher than 7,500 or 10%, but we're very close to that. We always push it as low as we can. Then we've got everything else going toward his paid up additions rider. The STP, what that stands for. So I've been working with Guardian for a long time. My wife's name is Tara, so it actually represents Steve and Tara Parisi, because we've done a lot of business with Guardian over the years. They said, hey, we want to honor you by naming our paid up additions rider after you. I'm just kidding. It does not stand for that. That represents their 5% PUA fee. So you can tell I'm a weirdo when it comes to life insurance, right? So there's our funding, $75K per year for 10 years. That's his plan. Here's his cash value. Here's his death benefit. All right, we're going to look at this on Excel, and we're going to look at a couple different assumptions. But what we're also going to look at is the 10-pay policy. So we'll see the product name up here. 10-pay, same $75K per year. Look at that minimum premium, $12,500 instead of the $6,800 and change. It's actually closer to $13,500 when we add the term insurance rider, as we would have to pay that as well. So let's take a look here, and we're going to walk through the L95 policy first. He liked that one because of the low fees. What we're going to look at is something that I think is super beneficial for everyone to look at. The guaranteed values first. What are the guarantees? So important to look at. A lot of times they're overlooked. So the guaranteed cash value interest rate with this product is 3%. There's the money going in, 75 for 10 years. Break-even point occurs in the 9th year in this example. The guaranteed rate is 3%. Does that mean his money is growing by 3%? No, there's your annual yield, which displays the net yield year over year. Very important to look at that. Now, with the major mutuals, especially when they're designed like this, we've always seen them deliver much more attractive results than what we see on the guaranteed side of an illustration. So here are values based on their current dividend interest rate. Check this out. Break-even point is now year 4. And then we have the indexed rider values, which allows him to tie his cash value to the S&P 500 index. And how the indexing works is if the S&P goes up, you participate with the gains. If it goes down, your principal is protected. And you actually have a 4% floor with this Guardian product, but they charge a 2% fee, which actually makes the floor about 2%. But anyway, when we look at it, what you'll notice is a bit more upside on the cash value growth. So if we just look at the yields down here, you're closer to 5%, whereas the dividend with this product peaked at almost 4.3, 4.35%. So we can see the difference there. That's the L95 product. Stronger guarantees, lower fees, more cash value up front, breaking even between year 4. If we add a lump sum, taking advantage of that 50x rule, you're going to see a break-even point usually right around year 3. Sometimes it's between years 2 and 3. But let's compare this to the 10-pay product. We'll do the same thing. Look at the guaranteed rate with a 10-pay. It's 2% instead of 3%. The guarantees are not as attractive as the L95. We're going to look at a side-by-side in a moment. Let's look at the dividend values. These will look more attractive than the L95. The L95 peaked at about 4.35%. This peaks at more than 5.1%. So very attractive in that respect. And then we've got the indexed rider values, which looks very good. And this is what he was interested in. He was initially interested in an indexed universal life insurance product, but after learning some of the drawbacks there and how we haven't seen any historical proof of those working, he decided not to pursue that, but he still wanted that indexed potential. So he does like that. So let's wrap up by comparing these two, because this is exactly what he did. Starting with the indexed comparison, side by side. Here we go. You've got the L95 compared to the 10-pay. Because you have a lower guaranteed rate with the 10-pay, what that means for someone who's focused on cash value, we need a lesser death benefit in order to get the same MEC limit, or in English, we can put the same amount of money in without messing the policy up and triggering a taxable event. So when we look at the difference here, what do you notice? For the first 10 years, the 10-pay policy has less than the L95 policy. But from the 11th year onward, the 10-pay policy has more than the L95. Same company, same dividend interest rate, but different results. That's based on the indexed rider values. The dividend values will show a similar story. Then we've got the guaranteed values. There you go. Now what do you notice? Now the L95 has more from start to finish. Now it's always produced better values than the guarantees. However, this is something important just to hit on, because imagine if you went with a policy and you see the numbers, so this is what you think it's going to produce, but then after you start it, you see what's guaranteed and you're like, wait a minute, I went with that 10-pay because I thought it would have more money. I didn't know the guarantees were that bad. I would have liked to have seen that before starting the policy. That's why we like to show that. With that said, after looking at both of them, he likes the L95. As of right now, he might pivot, as we still can do that. He hasn't started the policy yet. He just started the underwriting process. But with that low minimum, stronger guarantees, that was very appealing. The 10-pay we've seen work very well for folks that have a lot of excess cash on hand, and they're very, very focused on the long-term performance, specifically when we look at the non-guaranteed side of an illustration. So, how do I get as much cash value as possible? Number 1, company choice. 2, policy design. 3, squeeze the policy for all that it's worth. by knowing the rules of the game. 4, flexibility. Understand the rules of each specific company and product, or make sure that your agent understands them and then explains it to you. 5, dividends. Understand how they work from a transparency standpoint. Remember, you're never going to see your money grow by whatever that actual dividend rate is. And number 6, loans. Understand the nuances. I hope you enjoyed this video. I had an absolute blast with it. If you liked it and would like to see more content like this, please let us know in the comments below. And as always, I hope this helps.